To avoid mistakes when filing corporate taxes in Canada, it is essential to keep diligent records, report all income accurately, properly classify expenses, and meet all filing deadlines. Failure to do so can result in penalties, interest charges, and an increased risk of a Canada Revenue Agency (CRA) audit. Key corporate tax mistakes to avoid: filing and payment errors. Missing deadlines: you must file your T2 corporate return no later than 6 months after your fiscal year end, and pay any balance owing within 2 or 3 months, depending on the corporation. Failure to meet these deadlines will incur penalties and interest. Ignoring quarterly installments: if your corporation owed tax in previous years, you may be required to make quarterly tax installment payments. Missing these payments can lead to interest charges. Using the wrong forms or codes, filing the incorrect T2 schedule, or misreporting a GST or HST amount can cause delays and lead to a reassessment. Let's look at a case study. Innovate Inc., a growing tech firm, missed their T2 filing deadline by a month, resulting in an immediate late filing penalty. They also overlooked a quarterly installment payment, which accrued interest. To top it off, they used an incorrect code for a GST return, causing a processing delay and requiring a reassessment. Income and expense mistakes. Underreporting income. Always report all sources of income, including grants, investment earnings, foreign income, and revenue from digital platforms. The CRA can cross-check reported income with third-party information. Misclassifying expenses. Distinguish carefully between capital expenses, long-term assets like equipment, and operating expenses, day-to-day costs like rent. Incorrectly classifying these can distort your financial records and lead to issues during an audit. Claiming ineligible expenses. Do not deduct personal expenses as business costs. Examples include personal use of a company vehicle, excessive meals and entertainment, or mixing business and personal bank accounts. Insufficient documentation. The CRA requires detailed records, including receipts, invoices, and mileage logs, to support your expense claims for at least 6 years. A lack of documentation can result in denied deductions. Overstating expenses. Claiming unusually high expenses compared to industry standards or your corporation's income can raise a red flag for the CRA. Improper payroll reporting. Accurately classify workers as either employees or independent contractors. Misclassification can lead to payroll tax penalties and back payments. Shareholder loan issues. Loans taken from a corporation by a shareholder must be handled carefully. If they are not repaid within a specific time frame or are used frequently, they may be deemed personal income and taxed accordingly. Missed opportunities and strategic errors. Overlooking deductions and credits. Missing out on eligible deductions such as the scientific research and experimental development, SR&ED credit, capital cost allowance, and home office deductions can lead to overpaying your taxes. Failing to register for GST, HST. Businesses with revenue exceeding $30,000 must register for and remit sales tax. Forgetting to do so can result in missed deadlines and unpaid remittances. Not seeking professional help. If your corporate taxes are complex, a tax professional can help you navigate the system, ensure compliance, and maximize deductions, ultimately preventing costly errors. If you like our contents, please don't forget to like, share, subscribe, or to contact us at www.easytaxcanada.com. Thanks for watching.